What's up everyone, it's Scotty with MoneyBest. So in this video, I wanted to break down the 11 sectors in the S&P 500 and which ones do I consider right now to be fairly valued, undervalued, or overvalued at the moment. We're also going to run through the technical analysis on all 11 sectors. So hopefully this video is going to be super valuable to kind of plan your trades and better understand the technicals for a lot of these different sectors within the S&P 500 and also understand the valuation of each sector in the S&P 500 as well. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. That's all I'm asking in return, and link to our Discord and Patreon is going to be down below. The first week of the month is the best time to join. And of course, you get access to all the buy and sell alerts, options alerts, trade ideas, members only private videos. Everything is going to be included with the link down below, and we'd love to have you on board. So first things first, let's talk a little bit about these sectors themselves. So S&P 500 has 11 sectors within the index, right? So obviously we've got communication services, and this communication services includes your big tech companies like Meta and Google. Information technology, of course, is going to include companies like Apple and Microsoft, and consumer discretionary is going to include companies like Tesla and Amazon. So year to date, it is without a doubt these three sectors that have outperformed significantly. So comm services is kind of leading the way, up over 39-40%. We got information technology up over 33%, and consumer discretionary is up a little bit over 25% as well, with the overall S&P 500 up a little bit over 11.6% on the year. Energy is going to be another sector. Obviously, that's going to include your energy companies. In the last 1 month, in fact, it is up over 3.45%. This is the only sector that is green in the last 1 month, and year to date, it's up over 3.25%. So up until this last 1 month, energy was indeed red on the year. Industrials is another sector, year to date up 3.15%, so very, very small gain, and materials are barely up over 1% year to date, and all these sectors are basically down on a year to date basis. So we got financials, we got healthcare, we got staples, we got real estate, and we got utilities, all down anywhere between 3 to as much as 16.5% on the year. But these are the 11 sectors that make up the S&P 500. Now, when it comes to individual stocks themselves, you'll notice that utilities have the fewest amount of stocks at 111, and healthcare has the majority of stocks at 1,267, followed by financials at over 1,100, and technology at almost 800 stocks, with of course majority of that market cap coming from technology at $13.7 trillion, followed by banks and financials at $8.5 trillion. Then we got healthcare at $7 trillion, consumer cyclicals $6.4 trillion, comm services at $6.2 trillion, industrials $4.6 trillion, so on and so forth, and utilities only have $1.1 trillion in market cap at the moment. But of course, they've got the fewest stocks. That makes sense because they've got the lowest amount of market cap. But technology, even though the number of stocks is less, makes up majority of the market cap at $13.7 trillion, even though they've got significantly less stocks compared to financials and healthcare. Now, this right here is the performance once again, but in a little bit more detailed format. So what you'll notice is the last quarter, right? So if you take a look at Q3, energy has been a very, very strong performer, 10.4% increase in the last quarter versus comm services, which is up 3%, and everything else is down in the last quarter. So energy has been the clear winner over the last week, over the last month, and over the last quarter. And in the last half of the year, except comm services, still kind of leading up over 16.8% in the last half. But of course, year to date, we already went over. Year to date, energy is nowhere near close to the likes of comm services, technology, and cyclicals. Now, this right here is going to be the valuation. This is where we are probably going to spend majority of our time kind of understanding where the valuation is for these individual sectors and what makes more sense from a risk-reward standpoint and from a valuation standpoint. So what you'll notice is that healthcare, materials, real estate, and defensive, so these 5 sectors have the highest amount of PEG ratio. PEG ratio meaning the PE ratio relative to its growth. And they're all above 2.3, 2.5, 2.7. Even though, if you take a look at their forward price earnings multiple, right, on an absolute basis, yes, you can make a case, you can make an argument that, look, 16 times price earnings multiple for healthcare is cheap, 13 times for materials is cheap, 26 times for real estate, arguably not that cheap. Consumer defensive, 17 times is cheap. Utilities at 14 times is cheap. But the growth rate is not that high. And because of that growth rate, that P multiple, even though on an absolute basis may seem a little bit lower, on a price to earnings growth basis or PEG ratio basis, it is red. It is pretty expensive because in other words, the forward PE is more expensive relative to the growth rate that these sectors bring to the table. And as a result, they are, at least in my opinion, looking at these numbers, still a little bit too high in terms of those ratios, in terms of those forward price earnings multiples. So is there opportunity individually for individual stocks? Yes, I think there is opportunity in healthcare. I think there's opportunity in consumer defensives for sure. I think there's opportunity in utilities because there's a few companies that have been selling off more recently. But on an aggregate, on an overall sector basis, the PEG ratio is a little too expensive for my liking. Now, when we come down a little bit, right? So when we start looking at consumer cyclicals, technology, and comm services, more specifically, technology 21.88. It's kind of like the opposite of what we are going over for these stocks. And what I mean by that is that even though these indexes and these sectors on aggregate may not be the buying opportunity on aggregate, there's individual stocks that are trading far below the PEG ratios, and there might be buying opportunities in individual stocks. With technology, it's the quite opposite. Even though their PEG ratio is 1.95, and their overall forward price earnings multiple is 21. And for consumer cyclicals, it's at 16, right? So that's even cheaper. That's even lower. And again, PEG ratio is at 1.95. Communication services, we're looking at 16.5. So that's the number right there. And 1.29 PEG ratio. Individual stocks are obviously trading at higher levels, higher PEG ratios. And as we have gone over already in one of our previous videos, for example, Microsoft trades at over 3 times PEG ratio. Apple trades at over 2.5 PEG ratio. So it's kind of like an opposite to what we went over for the first 5 sectors. I hope you understand. Like, even though on aggregate, these sectors, yes, they do make sense, but there's individual stocks that are actually trading at higher PEG ratio and higher forward PE multiples, as opposed to these right here on aggregate may seem like expensive, but there's individual stocks that are obviously trading at lower and cheaper levels. Now, financials, I would argue, financials is one sector that I would argue is actually looking at pretty good numbers here. 1.24, 11.7 times earnings multiple. And that is one sector that I believe there is opportunity. And the reason for that is because interest rates are higher and they're potentially going to be higher for longer. And if they are higher for longer, well, guess what? Their net interest margins for banks is only going to get better, right? Yes, they are holding on to, $600-700 billion worth of unrealized losses up until maturity. But that being said, the big banks, the SIB, systemically important banks, there is opportunity in my opinion, especially when you come to XLF, VFH, some of these financials ETF that do pay out a 2.5% dividend yield, and also, relatively speaking, relative to their growth with the higher net interest margin, considering the rates are going to be higher, and the 4P multiples, there is opportunity. Now, energy is quite an interesting one, right? Energy is very, very volatile. It kind of trades off of oil prices and whether oil prices are higher or lower. So right now, 9.71. We don't have a PEG ratio here for energy, but again, it's going to be very cyclical. It's going to be very volatile depending on where oil prices are. So of these, the conclusion that I come down to is that, look, if you are looking at ETFs, and again, broader aggregate ETFs, consumer cyclicals, technologies, and comm services all day long. No problem with that. When you're looking at aggregates on ETFs for healthcare, not for me. Consumer defensives, not for me. Utilities, not for me. However, individual stock-wise, yes. Individual stock-wise, yes. Individual stock-wise, yes. Individual stocks for consumer cyclicals, technology, and comm services, we got to look at our fair values. We got to look at where the intrinsic value is and where the prices come down to before they start to actually represent some good deals. The thing is that obviously, even though there's technology stocks like Apple and Microsoft and Tesla and Nvidia like that may be considered as trading at an expensive valuation, the other 90% of stocks that are in the cyclicals and technologies and comm services are nowhere near close to these big tech valuations, right? And because of that, it's kind of averaging itself out. And as a result, the aggregates are still pretty reasonable at these multiples. So hope that makes sense from a fundamental evaluation standpoint. Now, going over to some of the numbers here. So the reason why there is, these sectors like healthcare, consumer defensive, utilities trading at a very high and expensive PEG ratio is probably because of the forecasted earnings. So what you'll notice, the healthcare, it is expected to decline a little bit. So this right here is going to be the small decrease in 2023-2024 earnings per share. This right here is going to be industrials. Once again, we're starting to see a little bit of a pullback. Information technology, for example, expected to rebound. So you can see that uptick coming back in. This right here is going to be consumer discretionary. Once again, that uptick coming back in. Comm services, you can see a significant increase once again in earnings per share. And this is S&P 500 kind of moderating a little bit in 2024. Going over to consumer staples and some of the other sectors of the S&P 500, and what you'll notice is energy expected to once again decline. Real estate expected to moderate and keep going down a little bit. Materials also expected to decline and keep going down. Staples expected to kind of flatten out a little bit, so normalize. And we got financials also considered to stabilize a little bit and start turning sideways. And utilities also very much to the sideways and more stable at the moment. These are forecasted earnings for 2023-2024, right? Now, when it comes to the technical trends, we already went over the valuations. Let's talk a little bit about the technicals here for these indexes and these ETFs and these sectors more specifically. Comm services was on a very nice consistent uptrend, higher highs and higher lows up until more recently where it broke down below the 50 simple moving average, and now we are obviously starting to see some lower highs and lower lows. So we'll consistently monitor where comm services kind of settles in and starts to move back higher. Technology, same thing. So it's kind of trading in this lower high and lower low pattern, broke down below that 50 simple moving average, and we're now starting to see some downtrends for this sector as well. Talking about consumer cyclicals. So consumer cyclicals here, also a very identical pattern to technology and communication services. Lower highs and lower lows broke down below that 50 simple moving average. So the short-term downtrend is still pretty valid. Now, energy is still in very much of an uptrend, still validating that higher high and higher low pattern, of course, as oil prices have continued to move higher. So technically speaking, energy may suggest some more potential upside, considering that it's been the best performing sector in the last quarter, in the last 1 month, and in the last 1 week. And there is technical upside here, considering that it's trading in a very nice uptrending channel of higher highs and higher lows. And there may be a buying the dip opportunity here once it tests its moving averages once again. But of course, other sectors, they are starting to show signs of weakness with those lower highs and lower lows, and they're now starting to rebound a little bit, considering that we've hit our lower low, which again, we talked about in our previous market updates. This right here is industrials. Industrials have been on a straight decline here, trading below those moving averages, so technically very weak. Financials, I would argue, are more stable. In other words, there is a pretty good support right here, even though they are making a little bit of that lower high and, of course, trading below those moving averages. So from a technical standpoint, maybe not the best tradable opportunity, but fundamentally, as I mentioned, there is value and there might be a dislocation considering that interest rates are going to be higher for longer. The net interest margin is going to get better as interest rates continue to be at over 5+%. And fundamentally speaking, looking at the forward peg ratio, it is quite reasonable at under 1.5. Looking at basic materials, so this right here, again, making lower highs and a little bit of lower lows, trading below those moving averages. So technically weak at the moment and obviously not doing the best, but it is got a very nice consolidation where it has been trading in this pattern where it's, lower highs, horizontal highs and horizontal lows. So this right here could be a potential opportunity to look at it from a swing trading perspective in the materials sector. Healthcare also has a pretty strong resistance here. We are not able to break past that level. We did actually break down here in 2023, then of course rallied back higher. And right now we're once again trading below those moving averages. We are making those lower lows for healthcare as well. So definitely very, very weak. And finally, we come over to consumer defensives. A very significant sell-off here. I mean, there's been a lot of selling pressure in consumer defensive and staple stocks. And this right here is going to be the sort of like the horizontal range within which it's been trading at. But right now, more recently, we have seen a breakdown for defensives, not only below the moving averages, but also below the horizontal support. So from a technical standpoint, yes, there may be an opportunity from a reversal trade perspective, but it is really, really weak, and we have to be very careful, understanding that, okay, even from a fundamental and technical standpoint, it continues to look pretty weak. Real estate here, just selling off. There's been a lot of selling pressure for a lot of REITs. We've talked about this in one of our previous videos, and, obviously trading below those moving averages, and right now down about 7% since October. And it's pretty much coming down to its 12-month low right now. And finally, we got utilities. Utilities also very, very weak, making lower highs and lower lows here and trading below those moving averages in a very strong downtrend. This right here was a support that it validated a couple times and it finally started to break down, especially when Nextera Energy also has been selling off. I did a video on that in the last week as well. And finally, so again, we're going over these now in a more sort of candlestick pattern chart standpoint. So this is going to be XLF, lots of consolidation. Support level I would watch is around 29, close to $30 per share. Very, very important support. This right here is going to be your utilities. Very strong support here up until that recent breakdown that we witnessed. And now we're back to the same level as where we were back in September of 2022. So this right here is a support. In case we see a more persistent selling pressure, more downside here, then $53 is going to be that next support, the same level coming in since 2021 for utilities. When it comes to staples, we are now sitting at support at $68, but a much stronger support is going to be sitting right over here at around $64, $65 per share. That would represent a decent swing trading opportunity, but a much better ideal level, closer to $59 in line with this level right here from back in 2021, right? That was a very nice uptrend, so making higher highs and higher lows. So you'll notice that it was on this consistent uptrend here. And then after that, it obviously started trading sideways, and then it's now starting to see a little bit of that breakdown and some lower highs as well. And finally, we got XLC. So what you'll notice is that comm services, technology, and discretionary did not consolidate as well as the other sectors that I went over, right? They obviously had a pretty brutal selling pressure. This right here was all of 2022, and they had a pretty brutal sell-off and a bear market of 20+%. And now they're starting to see that V-shaped recovery where they are now on their way back up. Versus like energy or staples or defenses, for example, they're moving sideways. They were always moving sideways. They were consolidating in that range. So, for example, communication services still very much in an uptrend here. I would argue it is nice higher highs and higher lows. So very important support sitting right over there, $66, $64 per share is going to be that level. Same thing is true for technology. So had a little bit of that V-shaped recovery. So back higher, obviously had a very brutal sell-off. And we actually did analysis on this not too long ago. And I mentioned two potential outcomes, 1 and 2, right? 1 being coming down to this new lower low. But obviously we took number 2, which is basically making higher highs and higher lows. And then breaking out even further, coming up to a new all-time high of $181 and now starting to make these lower highs and these lower lows. So that next support is going to be $150, which actually would be a very nice area of resistance from the past, which will represent some nice potential opportunity to swing trade this back to the upside. This is also a level where you could consider TQQs or something that's a little bit more levered that will offer a better risk reward trade-off, but of course be careful because leverage does eat into the decay factor and there is volatility with leverage ETFs. And then finally, we come over to XLE, which is energy sector. So energy also has seen some sell-offs over here, but still in the context of this ascending triangle where it continues to kind of coil in. And I wouldn't be surprised if oil prices, obviously depends very much on the oil prices, if you do see a breakout in oil past $100 per share. It's possible that XLE, energy sector, breaks out to new highs at over $91, $92 per share. And finally, we got materials, which once again have been consolidating sideways for such a long time. There's been a range, resistance right over here, pretty strong supports right over here, $66, $67, and some more intermediate support right over here at around $75 per share. So two support levels at 75 down to $66 per share for materials. So hope you guys enjoyed this video and a complete update on the individual sectors of the S&P 500. Let me know your thoughts down in the comment section below. What do you think about individual sectors? Are you buying any specific ones? Like I said, on a more aggregate basis, technology, comm services, discretionary does seem a little bit better. Individual stocks, we already know they are a little bit more expensive, so fair values are going to be something that I'm watching. And then when it comes to energy, energy I think has potential from a trading perspective, and then financials from more from a fundamental standpoint, and then some of the other ones like defensives, materials, healthcare, those ones fundamentally do look a little bit more expensive, but individual stocks, I do believe there's opportunity to trade them. And there's, technically speaking, again, there's a lot of different tangents that we're pulling on because we look at them from a fundamental and technical standpoint, investing and trading perspective, right? So there's a lot of different things to look at where there's opportunity. So hope you guys enjoyed this video and found it helpful. Make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below. Again, links to our Discord and Patreon with that 16% annual discount that's available for the first week of the month. As always, happy investing, and I'll see you all in the next video.